Good evening, all. Thank you for making it. It has been said before, never make predictions, especially about the future. It's an expression that has long been attributed to our diverse collection of individuals. Niels Bohr, the Danish physicist, Mark Twain, the American author, but never to our editorial teams at Reuters Breakingviews, who have built a great track record of nailing its colours to the mast with their annual predictions. A year ago, the team predicted Deutsche Bank would have ousted its leaders. Accounting fraud would become a top regulatory priority, and oil prices would plummet, perhaps not to $30. They called it. So as we leap into the new year, on behalf of Thomson Reuters, I am delighted to welcome you this evening to the launch of Reuters Breakingviews Predictions for 2016. For those of you who have already had a chance to read those predictions, you will notice a musical theme to the narrative. It's the end of the world as we know it, or at least we've known it for the last 7 years. The money for nothing that fueled government and individual spending, emerging markets and the allure of risky financial assets will start going the way of disco in 2016 as the US Fed raises its interest rates. For nations, corporations and individuals with a strong balance sheet, it could be a very welcome shift, perhaps even a stairway to heaven. For overvalued businesses, profligate governments and high-yielding markets, danger lies ahead, perhaps a highway to hell. So stairway to heaven, highway to hell is the theme of Reuters Breakingviews predictions this year. And it's sometimes easier to predict, or it seems easier to predict, the highway to hell. Geopolitical risks will likely produce more tragedy in Syria and Yemen, a constant stream of refugees across Europe, another round of the Brexit crisis. Will Brexit become a crisis for the UK? George Osborne last week talked of a dangerous cocktail of new economic threats and told us to get ready for an interest rate rise. George Soros also spoke last week, telling us it's 2008 all over again, warning of an impending financial markets crisis. Investors around the world are roiled by turmoil in China again, as they struggle to find a new growth model with its currency devaluation transferring problems across the world. But let's leave room for a little optimism at least, and think of that stairway to heaven. There will likely be fewer wars in 2016 than for many years. Elections for two of the top jobs in the world, in the US and the UN, could produce women for both for the first time. The Fed liftoff could reinvigorate key market gauges. Virtual reality will spring into life into 2016. Science will tell us more than we ever knew about our ancestors, ourselves, and our universe. And you never know, England may even win the Euro Football Championships. But without further ado, thank you in advance to our panelists and to the Reuters Breakingviews team for being challenging, stimulating, and as always, insightful. I'm looking forward to this evening to hear their insights and help give us a leap on the year ahead and hear more about what 2016 has in store. Please welcome, to introduce our panel, the editor of Breakingviews, Rob Cox.
Thanks, Steve. Thank you very much. Thank you all for coming out. I know it's not the best night. There's apparently snow in the forecast, which we did not have in New York. So maybe I brought it. So thank you very much, Steve. Let me go quickly introduce our panel, and then we're going to get right into some of the opportunities and risks that Steve just mentioned. To my right is Kay Swinburne, who is a former investment banker turned gamekeeper, and now negotiating on EU-wide financial regulation. She has recently been involved with approving new MiFID II trading rules that promise to reshape the city. She's also an active member of Wales' campaign to save the bumblebee. Is that correct?
Honeybee.
Honeybee, okay, honeybee. Sorry.
There is a difference.
No, I know. I'm allergic to one.
Me too.
Okay. During Xavier Rolet's 6.5 years or so, is that right? Six and a half years? 7.5 years. As
No,
boss, seven.
Even.
Okay, 7 even. It's an odd number, so but as the boss of London Stock Exchange, the LSE has given shareholders a 25% annual return, many times better than most of the other companies listed on the exchange. The LSE hosted more than 40 billion pounds of equity raising last year, and I believe you have a beehive on your roof.
Yes, no bumblebees in my
Not honeybees, so you have common cause here. Sergio Ermotti just got back from China, where he said that UBS will double its headcount in the next 5 years. The bank is leading European rivals on returns on equity and growing its private bank. The bank is experimenting with altruism-inspired investment, raising a fund to invest in developing cancer treatments. And the bank also seems to have recently made Annie Leibovitz its house photographer. I was curious. Oonagh McDonald is a regulator extraordinaire and has variously been tasked with overseeing UK banks, housing prices, commodity exchanges. She recently advised Mongolia on pensions, Nepal on capital markets, and the Ukraine on regulating financial institutions. She was also once a philosophy professor. And last but not least is my colleague, EMEA editor, John Foley. He and I are going to moderate this together. We're going to go through a couple things, and then we're going to give you guys a chance to ask questions, so please start formulating them. First thing I want to talk about, speaking of predictions, or more, I should say provocations, is what we do. Let's start with a year from now, when President Trump is inaugurated, and okay, we'll do that later. We save politics for dessert. But seriously, this year has begun, it's been a crappy year in the markets. We started out, I think we saw the worst start, at least in the Dow Jones and the S&P 500 and many other global indexes, in a generation or more. So let me ask a technical question. Should we start freaking out now, or is this something we don't have to worry about? I'm going to start with you, Xavier.
So one thing I learned in financial markets, in fact, what I was told when I was a young trainee is one was about research, I'll talk about it in a minute, but the other one is don't panic. I don't think there's reasons for panicking. And we can talk about China in a minute. We can talk about interest rates. Certainly the first week of this year has been pretty dreadful from a performance standpoint, but there are no reasons to fear anything on an inflationary front. In fact, inflationary expectations continue to decline, and that's not an environment where typically, as we see underpinned by weak commodity prices, you should expect any sort of aggressive rate hikes. And I'm certain that this is not consensus opinion, but in a world that is underpinned by continued availability, even if there are a few little upticks every now and then, continued availability of cheap money, where China is undergoing a very deep restructuring in terms of governance, in terms of the sustainability of its economy, in terms of the shift from state-driven investment to consumption. Repeal of the one-child policy was a critical factor, not one that has received a lot of attention. Where a lot of restructuring is going on, I think it's going to be a very busy year indeed, but I'm not as bearish as many.
How about you, Oonagh? What is your sense?
I think continued volatility in the markets, but I certainly don't think it's time to panic about the financial services sector, if I can kind of put that on one side. My concerns are with the Middle East, and I see endless problems there, and I speak as someone who never ever said the Arab Spring. Right from the start I said the Arab winter, and as we can see it's a horrible and prolonged winter. So that is one area where I feel that real problems could arise, which will obviously in turn affect the industry. The other area is of great concern to me, and that is increasing and more blatant corruption in emerging markets. I've just come back from Malaysia, where, as you all know, the Prime Minister didn't even trouble to hide the corruption. The money was paid directly into his personal bank account. And other very strange stories that I heard about the way in which he was trying to calm that situation. We all know that corruption is rife. I've also worked a great deal in Ukraine with the regulatory authorities there over recent years, extremely corrupt. And I think what is happening, why I'm drawing attention to this, not obviously because of the destructive impact of corruption itself, but because of the people's reaction to it. I think they all know it's going on. It goes on at daily level in their own lives, and they don't want to wear it anymore. And so I think we'll see strong reactions to that in some of the emerging markets in Asia.
How worried are you, Sergio? I mean, you're expanding in China, or you're bolstering your presence there. I mean, what worries you?
Well, what worries me, first of all, our expansion in China is over the next 5 years, and is 1% of UBS account. So, of course, we are doubling, but it's 1% of our head count, and we look at those kind of investments with a very long, term commitment. What worries me is the convergence between those macro issues that we are still outstanding. Europe, China situation, and I would say that is a close call if the Fed is going to really hike, and we're going to see if there is real sustainability on the U.S. economy recovery. So a convergence of macro events with geopolitical escalation for sure makes me feel like it's going to be a year of intense volatility on all asset classes, and which is not the good volatility, the quality volatility that we need in our businesses. Is bad volatility. Is like kind of a liquid. It's like water going into freezing temperature.
Right.
And that's not really. So we have to be realistic that it's not time to panic, but people shouldn't confuse realism with pessimism.
Right. And Kay, are you freaked out? You don't seem to be.
Well, for me, 6.5 years in the European Parliament, and I joined in 2009 in the wake of the financial crisis, and the Eurozone crisis then came along quickly on its heels. So I feel as if I've been doing this job throughout crises. Mm-hmm. So, and they've never really come to an end. The interesting thing for me this year is I see all the geopolitical risks, and I'm sure we'll touch on many of those, as Oonagh has said, and I think there's some big Russian geopolitical risks that we really need to take into account. Some of my Baltic colleagues are getting very seriously worried, and some of my experts in foreign affairs are really saying that it's going to be the year that they are going to have to actually step up their game. But the real concern for me is whether or not, with this increased volatility, I no longer have to deal with the financial markets directly and worry about my P&L, but actually what I have to worry about is whether or not the action we took since 2009, whether or not those actions we took to create a more stable environment for the infrastructure, whether it's going to hold up, whether or not it's going, during this testing time, to actually give us the stability that we thought it was going to do. And I think globally, G20 put in place a whole heap of arrangements around the globe, and I wonder whether or not those measures are going to actually prove useful, or whether indeed we're going to see some issues about capital with regards to some of our banks being stretched because they haven't got the spare capital to actually fund the economy, and therefore we're going to see all sorts of second and third order effects from this.
Okay, so we know what the panel sort of is worried about broadly. Do you want to ask?
Yeah, I was going to say, this would be a nice moment to have the obligatory show of hands session in the audience, because we actually put this question to our own readers recently in an online survey. We said, what are the things that are keeping you awake at night? And a lot of the same themes came up. So if I ask you guys, like, of some of those issues that the panel have raised, so corruption, the Middle East, China, the European economy, and Russia, who would say that the most worrying of those, for example, is corruption? Right. Commodity prices? The Middle East? Oh, wow.
Yeah.
Russia? Okay. And Europe? So the Middle East is clearly the thing that people...
Right. So let's sort of sweep into that a bit. And the Middle East can be also, I think, certainly Islamic State is the great worry factor there as well. But I don't think it's just that. I mean, Saudi Arabia and Iran potentially beating each other up was not something 3 weeks ago we were anticipating when we were putting our, to bed our book here. I mean, what is your worry about the impact that a potential, let's call it rising and escalating tensions between the two superpowers of the Middle East could have on your forecast for, your business in the world, Sergio?
Well, if I have to say that we already see for the last almost 4 years our client risk appetite being at the lowest level, and it means hundreds of billions of cash and very, very low risk appetite. I can only imagine that the biggest risk for us is a real new wave of people basically being willing to pay for cash. Mm-hmm. Which, if I look from a bank standpoint of view, is really not making money on deposits and actually having to put a lot of capital against deposits, almost like it would be a very risky asset, is the ultimate a dangerous cocktail you don't want to see. So I think that for our business, this is the biggest issue, risk aversion, and for risk, I mean, I would say, reasonable risk.
I suppose if you work hard, you might be able to offer them shares in Saudi Aramco if you get a mandate, which I'm sure you're diligently working on. And you, Xavier,
in that scenario you just described, in the scenario of Iran, Saudi,
I guess that's no good, right? That's called a
It's
hung
very
deal.
easy placement, right?
Oonagh, I mean, you spent time in a lot of these places, which are sort of tinderboxes.
Well, I guess my first and frivolous response is I guess the price of gold will start shooting up again, because that's typically what people would resort to in the Middle East. No, I am concerned. First of all, I'm concerned about the West's response. It is just so difficult to disentangle and to understand the various strands in Islam in the Middle East, which will find all sorts of reasons now to continue to attack each other. I am concerned about Iran and Saudi Arabia, the increasing decline in Saudi Arabia's economy, and its great difficulty in coming to terms with a different way of life. So those are the areas that first concern me. And the second broad area, of which of course we've been taking into account this year, is the impact of a huge increase in migration on Europe. Doubling of numbers this year, no signs of it falling off. Even refugees and immigrants fleeing from various countries are even still making their way across the Med in boats, whereas we might reasonably have expected that to decline. The great difficulties that so many countries have, for example, for us, to take in a lot of migrants when its effect on housing is the most serious issue, when we are probably at least 1 million units of accommodation short to provide sufficiently for the population as it is now.
Right.
So these are areas of great difficulty that I see.
Okay, if we asked fellow members of Parliament that sort of same straw poll that John did, I mean, do you think we'd come up with sort of the same, or would it be a different response, or would they say none of the above?
I think geopolitical as an entirety would come up, because they can't actually rank whether or not it's the Middle East, Russia, we have got, and North Africa, we have got on 3 fronts real instability. And I think to rank them is probably not a politician's job. And I think, we see that there are risks in all 3 of those geopolitical areas. And it's going to be a major problem for Europe, because ultimately, if you want stability and you want to bring up your family somewhere safe, you're probably heading towards the EU. And that would be where I suspect that the real tensions are going to come in Europe over the next 12 months and beyond, is this migration. I mean, we've seen the start of it. It's not the end of it. Some of the predictions from the UN are that there are many tens of millions of people looking over the next few years to actually move towards Europe. And we're not designed to cater for it. The UK may not have housing, but certainly we've seen the instance of Germany and the way that they did open their doors. I mean, the official numbers are just over 1 million. It's understood that there's approximately 2 million who arrived in Germany. The official numbers are nowhere near, apparently, what is happening on the ground. And when you talk to colleagues who are actually dealing with it, and households who are having to deal with it, the pressures on communities are huge, and we shouldn't underestimate this. I mean, we have our own comments in the UK about immigration, but we have no idea what it's like to receive 1 million official and potentially double that number unofficially into a country all in 1 year. Yeah. It's something that we've never contemplated. And I think that the pressures upon not just the economy, but on communities is not to be underestimated.
And Xavier, you're French. I mean, obviously the attacks in Paris.
Thanks for pointing it out.
But in any event, I mean, if you had this conversation with colleagues from high school or whatever, your French friends, I mean, how different would be the conversation from the way it might play out here in London or New York or in Frankfurt?
Well, France obviously has gone through a pretty fresh trauma linked to Daesh, and that is something that the country is working itself through. They are facing a presidential election next year, which is also reasonably hard to predict. In all the comments that I've heard, and when I look at the situation today, there's still somehow a number of things that are conflicting that I can't reconcile, and it will have an impact on markets. So the political situation is let's say, geopolitical grave, and there's a lot of uncertainty. We hear about volatility, we hear deep challenges. We're in a either low inflation, disinflation, or deflationary environment, with China basically trying to land somewhere. Europe, certainly the Eurozone is on its back. The levels of participation in the labor market in the United States are the lowest they've been in 38 years, 62.6%. So that points towards vast reserves of labor that's still unused in the United States. All of this is like lots of dark clouds. And yet, people are talking about increase in interest rates. And to me, those two don't jive. Why do you raise interest rates when inflation is not there? In fact, when the trend is a downward trend. So that points from my perspective, I'm not an economist, that points towards a continued, in spite of the recent panic, supportive monetary environment. And I think what's happened on the geopolitical stage, and the Middle East has obviously been here in terms of being a troubled area for a few thousand years. North Korea is also there, and that's an area that could undergo some significant changes. There definitely, in my humble opinion, been some attempts at regime change there in the last couple of years that have failed. But in 2015, what I believe we've seen is what military strategists call basically strategic surprises. You know there's problems in the world, but the things that have hit, the invasion of Crimea, small events like the bankruptcy of Puerto Rico, bigger events like all of a sudden the emergence of Daesh as a global terrorist force, if it is indeed that global. Events that we've seen in North Korea and many other events. Even here, back here at home, the Scottish referendum, right? This was not expected. It happened. For 2.5 months, the markets froze. These things were not expected. So the markets, whilst underpinned, and we've seen long-term volatility shrink for almost a decade, owing to the supportive monetary environment. Those very sharp spikes, what I think Sergio, perhaps, if I'm quoting him correctly, was referring to as bad volatility. It's almost like bad cholesterol versus good cholesterol. It's because we got this huge spike on the back of an unexpected event. We know the world is a troubled place, and we're not really sure how to analyze it. And so you get a huge spike, and then gradually a reversion to mean. So I'm not sure that 2016 doesn't have some fundamental conditions of a monetary nature. And also, I'm actually more positive about what's happening in China. You talked about corruption. It's clearly a big factor, but there's a very deep anti-corruption drive going on in China. A switch towards more sustainable economy, improvements in governance, again, focus on consumption, which I think is going to have in the medium term a very beneficial impact. Of course, you can't expect an $11 trillion economy to grow at 10% forever. But if China stabilizes with consumer growth picking up at 5% even, that's very positive. So whilst I know it looks quite scary at the moment, I think ultimately we'll pull through if our economies continue to devise and design and improve themselves in terms of their resilience. Because by definition, those strategic surprises are not things you can expect and plan. They surprise you. But if we continue to work on making our economies more resilient, and I'm particularly encouraged by the work that's going on in the European Union. I was in Brussels yesterday, and credit goes to Kay, many others, Commissioner Hill, to seek to re-equitize Europe, move away from excessive dependency on leverage and debt. So if we work on things of that nature, I think we'll be in a better position to basically deal with the challenges. We just talked about immigration. Yeah. Europe, from a population standpoint, is shrinking. Inflow in population, as difficult as it may be to handle for population politicians in the long run, are good for the economy.
It may be good economic policy. It's very difficult culturally to absorb.
In the short term, for sure.
That's case point. I mean, we did a panel in New York 2 nights ago, and one of the panelists, Ken Jacobs, who's the CEO of Lazard, was saying his biggest concern was actually that the Brexit. So his biggest worry, even though of the known unknowns, was that the British people would vote sometime this year to leave the European Union. I know
Don't ask me, I'm French.
Okay. But you run a business that depends on free capital flows. I mean, we're going to get into Brexit. Let's just do it. But I mean, let's talk about how that would affect potentially your business and the way you plan out what you do as a global universal bank, whatever you call UBS today. I mean, what would be the impact that you have, and would it be all bad?
Well, first of all, of course, at the end of the day, it's going to be a decision by the UK population but I'm quoting economists, so they have the numbers. I think the worst case scenario, we think, is going to be a couple of points of GDP contraction. So in theory, worst case scenario, that one, a mild exit, maybe less than a point. So you can argue that it's not a huge disaster short term, at least for the broader economy. When you talk about the financial services industry and all the complication, I mean, for us, for sure, as a Swiss bank, without passport already to Europe, a bank that uses London as the passport to Europe, like many other non-European institutions, it would have a clear repercussions on what we do in this country over time. And I was also thinking that if you add, the regulatory regime in the UK about the single person responsibilities and in a broader terms that is quite demanding, I can see why people maybe would come back and say, I'd rather do my global job out of New York or Hong Kong or Singapore. Why bother being in London? So I think that over the next 5 years, for sure, you would see a contraction of
And for the industry, I mean, we just saw General Electric yesterday decide to move its headquarters from one city, one state to Boston.
Is Connecticut going to leave the United States?
Connecticut is, I will lead the secession plan of that as a Connecticut resident. But no, it is interesting to see that they got Boston, Massachusetts gave them all the money. I imagine you would have the same sort of competition across the EU, wouldn't you? If you said, if this happened, why wouldn't Frankfurt, Madrid, Amsterdam, everyone compete to bring you, offer tax breaks, offer some great real estate, and I don't know.
London has lost a lot of attractiveness, for sure. I mean, until a few years ago was the undisputed place to be in respect of running a global business, and now is one of the places where you can run around. But for any, if you look at a continent, it's going to be very difficult to replicate London. So they're all going to benefit somehow, but they're never going to be able to recreate London. It's just Europe that loses. I mean, the bottom line of this debate, once again, you reinforce the polarization, US and Asia. And in the middle, you have Europe being the net loser.
Yes, but I'm not quite sure why, in leaving the UK in terms of regulation, you would be particularly better off in America. One of the things you mentioned in particular was senior management responsibility, which I think is an extremely important and probably beneficial concept in the longer term as far as banks are concerned. But what is also interesting is the changes that have been taking place in America. First of all, the Deputy Attorney General last September announced that they were no longer going to fine the company, fine banks, which, as you know, have suffered huge fines. What they are going to do in the future is to seek to hold individuals responsible, and very possibly senior individuals. Certainly some American regulators to whom I talked recently are looking with interest at the notion of senior management responsibility, and it does tie in quite well with the change in approach described by the Deputy Attorney General. A big change, in fact, because they had been pursuing companies for years, but they actually came under serious criticism for doing that.
I mean, they failed to put anyone but a sort of a low-level official at a bank in...
Exactly, but that is why it was because they had taken a decision at an earlier stage that it was better to go after the company. And then, of course, the administration saw possibilities of extracting enormous fines.
It was very good for the budgets of New York State in particular.
Yes, exactly. Running
true.
into billions of dollars. But they came under criticism from the judges for doing that, in particular Judge Rakoff, who said, look, this is not an honourable way to proceed. It's not even a moral way to proceed, because what you're doing is you're negotiating with the bank. Okay, so if we say in your statement you're prepared to accept responsibility for that, and the bank says, no, we won't accept responsibility for this, they come to an agreement, there's a short statement of facts, and you pay the fine. And that is not really the proper way to uphold laws and regulations.
So, sorry, on your point, I think if you have a situation like this one, which I don't disagree of everything you said about some of the merits of having more accountability with people, I think it's not just the senior managers that need to be on the hook, but also the people who are committing crimes that needs to be on the hook. Yes. But the most important issue, going back to the question, is that if you have those kind of regimes being applied globally, still net, people will say, why should I bother being in London? I can do those jobs out of New York, or I can do those jobs out of Asia. And net.
Or Zurich.
Or whatever. It takes away some of the attractiveness of London.
Right.
I just want to ask Xavier, seeing as you've played the French card in this question, how
He's watching.
Thinking as a European, because we're all very obsessed here in the question of, like, should Britain stay or leave the European Union, but how do people think about this from Europe? How should they think about it from Europe? Should they care whether we leave? Should they be trying to keep us here?
I have a different assessment of the continued competitiveness of London. Whilst clearly the last few years I've seen difficulties, the same has happened pretty much everywhere else. And we're seeing now that even in Asia, as the business develops, the systemic functions can also be difficult to manage. It's very easy to remain problem-free when you have no local balance sheet and when your companies are quite small, but as you can see that the size of some of these economies is growing and the governance perhaps sometimes is catching up. That's when you get into issues. So at times stumbling, if you do the right thing, helps you getting better. And I think there is evidence in some areas that not only London has continued to assess and maintain its global leadership, it has actually strengthened. But it's of course a constant competitive game. I mean, for us at the London Stock Exchange, our business is very global right now. We got 25% of our revenues in North America, 25% in the UK, 25% in the Eurozone, and the rest is in China, Asia, and a range of other emerging markets, present in 25 countries. We market in 95. So we have a truly global perspective, even though we're a small organization in terms of staff. I agree with Sergio that ultimately it's not for business to tell voters what they should say and what they should decide. It's not for us. This is a sovereign decision.
And I just point out that bankers and people in the city making the case for probably won't help the case for, given the populist view about bankers in the city.
It seems at the moment they're making both sides of the case, so I guess you might call this a hedge. But what I would say, though, what is, I think, legitimate for business to say is, in our area, in the things that we do, our best judgment is that if that decision is made, then that is what we think the consequences are going to be. And even that is very difficult because, okay, Brexit, it happens. How long does it take? How many years will it take to renegotiate 30 foreign trades that involve the UK that have been negotiated by foreign trade treaties that have been negotiated by EU, another 27 treaties that are internal to the EU's, free movement of people, educational, transportation, energy. It would take many, many, many years, not to talk about financial services, from clearing to banking, supervision. It would take many, many years for any sort of secession treaty or agreement to be negotiated. And until you know what this entails, what you have is uncertainty. And that points to Sergio's earlier, I think, comment is, in the meantime, certainly investment can be inhibited. But before business, where decisions like banks, automobile, and many others are made for the very long run, can actually make a decision, you need to have facts. And right now, we just don't know. We don't know what the treaty that is, or the concessions that are going to be negotiated by the prime ministers are going to be. And And until that is known, it's going to be difficult, obviously, to seek and map out the outcome of the referendum. So I do think that these issues are actually far more complex and can't really be summarized in a simple answer. It's just very, very difficult to model.
Okay, isn't the big signal, though, a negative one in the sense for the European experiment? The idea that we're closing borders, that things are closing down, that we're going back to some sort of slightly more isolationist approach, isn't that, I mean, I think back to Smoot-Hawley tariffs, you go back 100 years, there are these analogs or these precedents. How is that viewed in Brussels? Do people not see a potential Brexit as a potentially a real injury to the experiment?
Sure. No, they think it's a real injury to the UK. They can't understand why the UK would put everything at risk and jump into what they consider the big unknown. Not only is this an unknown what ends up with all the renegotiations that have to happen, they technically have to happen within 2 years. And I can tell you the average trade agreement that the EU does takes 7 years to do. So I'm not quite sure what happens once you get to 2 years and you're supposed to have already completed all the negotiations for your exit. So it's the unknown. And all I can say is that from my own personal point of view, I spend a lot of time in Norway and in Switzerland, because I work in financial services on the Econ Committee, and I spend a lot of time actually taking into account their views on what legislation needs to look like in order to actually accommodate some of the third countries, particularly our near neighbours in EFTA and Switzerland. And the real problems I have is I know I do not want for the UK financial services sector the Swiss experiment or the Norwegian situation in EFTA. It's not going to work for the UK. We are too large an economy. We have too large a financial services sector for us to rely upon similar agreements as the Swiss or the Norwegians have. So if it's not that, what is it? And I have no idea what it is. So in terms of a Brexit, it's the only time I actually say, if I don't know what the alternative is, isn't it better for me to stay and change what we have? And given that the reform agenda in Brussels isn't a UK reform, it's actually a reform of the entire 28.
And there is support for it.
And there is a massive reform agenda going on. You've only got to look at the Commission right now and look at the way they've restructured, look at the way that they've decided in this mandate since the last election, that actually the Commission is going to produce 20% of the previous mandate's legislation. That's not a reduction of 20%, that's a target of 20%. There's a big, big sea change going on in Brussels. Everybody are recognising Europe as an entity, as the EU, need to do less and they need to do it better. And because that general acceptance is there, I am all of the mindset right now, and because of the unknown, why on earth wouldn't you just stay and actually reform the EU and lead it? It's crying out for leadership.
What are you hearing from your constituents when you're back in Wales and you're hearing from the other sides? How are people seeing this? Are they seeing it in kind of rational and economic terms? I suspect not.
No, it's very mixed. Wales is one of the poorest regions of Western Europe, so we actually get a large amount of convergence funding for our competitiveness. Some 2.9 billion extra money comes directly from the EU to the Welsh Government as a devolved entity. And you would have thought, would have been a little more partial to the EU and to staying, and actually there is very little difference between the polling that's gone on in Wales and the polling that's gone on in England that don't get this extra amount of money out. So we are net recipients in Wales, and yet we don't see a particular appetite more than in England for staying. And I think part of that is the messaging, because everybody take this EU as a faceless entity and nobody really understands the detail of what's there. And I think it's beholden on all of us to get some facts out so people can make a decision based on fact. And politicians don't do that very well. So there needs to be someone else who comes along and fills the vacuum. I'd like it to be the media playing a real key role, but I certainly am not seeing that right now. We're seeing lots of head-to-head debates. It's people arguing at each other. There are no facts in those debates. Well, so actually, how do we get that so that people make a genuine decision and then choose either to stay or to leave, but at least know why they've made that decision?
I think politicians and facts is a really good segue into to populism. I mean, these are complicated issues. There is a lot of nuance, right? But it's very difficult, whether it's immigration, whether it's how to solve the Syria problem, whether it's Brexit. All around the world, though, we're seeing populism on the rise. So, it was probably 6 months ago, someone here was asking me when I was in London about, how long will it be before Donald Trump flames out? And he hasn't flamed out. The National Front. I mean, go across the developed political spectrum. Populism is really on the rise. It's very difficult to explain and get people to focus on truth and facts, even though we try very hard in the media, or at least some of us in the media. But we get the Twitter hate back when you say something legitimately correct about Donald Trump or Ted Cruz. How worried are you guys about the rise of populism? As someone pointed out on a New York panel the other day, it isn't actually self-correcting. History has proven that.
I think Europe has a particular track record. There's 100 million graves that have been built on the back of populism in Europe, the 2 world wars. And those demons don't feel that they're always very, very deep. And to go back over Brexit, the comment that Gay made, I do think it's really important that leadership, that British leadership be exercised, because the instincts of many politicians in Europe are not pro-trade, pro-free trade in particular, pro-business. Without the UK, Europe would be in a very difficult situation. And I've picked up in the last few months, for the first time ever, a sense of stress amongst senior officials there, whether parliamentarians or members of the Commission, that the future of Europe was not assured. And it's not just the potential for Brexit. And the one issue we have is there are 25.5 million unemployed people in Europe. Hasn't had enough growth, hasn't promoted entrepreneurs, hasn't promoted risk capital, innovation, and wealth creation enough in the last 25 years as an entity. That needs to be fixed. If we continue to rely overly on debt, mortgaging the future to pay for the things we all want, welfare, good transportation, healthcare, and other things, but we do not stimulate through the appropriate financing tool, the appropriate fiscal code, the appropriate regulation, the appropriate political leadership to encourage entrepreneurs, we're not going to create that wealth that's going to generate those 25.5 million jobs that we need. That, I think, is a real issue and a challenge for Europe. And what we're seeing is a reaction, people basically looking for solutions. And that populism is not very, very far. And past experience has been poor.
Go ahead.
I don't think it's so much that people are looking for solutions. I think the problem is that they feel that that events are taking place, decisions are made over which they have no control and no input whatsoever. I spent part of my time in France, and my young French neighbours say to me, yes, but we keep voting, nothing ever changes. In America, you have a rise of populism, dissatisfaction with what is described to them as the bank's behavior, bankers' greed, and so on. But that's not something that they could have controlled then. Decisions were made of which they were unaware. So I think that's what we have to understand. A deep sense of frustration, a lack of change. We're talking about Europe as though each country behaved in a similar way, but one of the problems in Spain, Portugal, Italy, is that you have to change the rules, and France too, of course, you have to change the rules for the way in which the labour market operates. That is one of the main reasons for high unemployment. You are not going to take on a new employee when you're going to be stuck with them for the rest of their working lives, or as long as they want to stay with your company, and you cannot sack them. So I think there's a lot that people see that is wrong, but they feel quite powerless to change it. And then, of course, along comes the populist who never, ever promises anything specific, anything in detail, but makes these wonderful, grand statements that if only he or she were leading, then everything would be different.
Well, they tap into the anger that's there.
Yes.
I mean, it is fuel. What were you going to say?
Just echoing some of the remarks of Xavier. Two issues you ask about risks. Number one is to, basically to continue to believe that ECB is the only game in town. And that's really the fundamental problem that we have today, because going back to the point about no necessity to hike. One could agree, looking macroeconomic, if you basically manage that situation with structural reforms. But there are absolutely, either they are working on it and the pace is not the one required, and therefore I think rely on this, the ECB still stimulating the economy is wishful thinking. So I think banks are...
This is the idea, it gives politicians a free pass.
Absolutely, and the free pass, and I don't want to comment on their views on also on the financial system, but I have to say that one thing is clear is that no banks cannot be sustainably profitable, or they cannot operate in a way that is expected by all its stakeholders if the underlying economy is not functioning. I mean, it's impossible, because at the end of the day, always remember that banks, particularly I'm talking about my peers and my colleagues that runs large commercial banks in Europe, they have a part of the balance sheet to take care of. It's not just granting credit. People are also giving banks deposits, and they expect to be paid back. And if banks just grant loans to unsustainable businesses, they're never going to be able to repay either savers or bondholders. So when we have discussions about the role of banks in the economy and stimulating, always remember the balance sheet. Second, which is the real worst case scenario, we mentioned Italy, we mentioned France, Spain, the Nordic, and so ever about the populism coming up.
Yeah.
We haven't mentioned Germany, and that's the real issue. It's not yet there yet, but can you imagine if you have a 20-25% part of the German population embracing those kind of ideas? I can tell you that it will move the debate about populism to a completely different level in Europe, and that's the real danger.
How do you see this playing out actually in the parliament?
For me, populism is an all-encompassing term, because we're seeing the rise of the left and the right. And so in Portugal and Spain, we've seen the rise of the left, and in Greece. And then when you're actually looking at France, it gets described in simple left and right terms as the rise of the right. And I guess with AfD and others in Germany, they also get called the right, but they have much more mainstream views than the National Front have. So it's all been grouped together, and actually they're very, very different.
Well,
but
Bernie Sanders and
all
Donald Trump have similar anger amongst their supporters.
They're all absolutely unique in their drivers, but actually the common ground here is that they're all picking up on people being unhappy with the status quo. And whoever's in government, they want something else. So it's the usual unhappiness here. I mean, the reform agenda that needs to take place in the countries that we mentioned, they are painful. But unless they continue, they will never have a modern economy. And then we'll drag down the whole of the Eurozone area because of it. Because we're not going to see the fiscal transfers that some want. It's not going to happen in the way that the United Kingdom has fiscal transfers between different parts of the UK. So we're not going to see that fiscal transfer. Therefore, reform is the only option for that area to actually find growth again. But populism is very different in different countries. And so I think when we put this label to it, we have to remember, in the European Parliament right now, I have got a very broad spectrum. I have got people who are part of the communist parties of different countries, and I have got people who are on the right of the spectrum that I would not want to be associated with.
You don't have any Tea Partiers, that's a good thing.
Well, I wonder where they would actually fall in that spectrum in Europe. It is actually such a wide spectrum that to actually find compromise means that much more is being done in the middle, where actually UK politics from left to right would be in that middle space. There wouldn't be the extremes to, the tails wouldn't be there. So I think when you actually look at this, you have to be very careful that you understand the prism is much broader elsewhere. It's not this narrow little focus that we think politics is in this country.
Well, we're going to open it up to some questions. I have one last one I want to ask you. It's sort of slightly a financial one. So Hillary Clinton, Larry Fink from BlackRock, both have talked about the excessive short-termism that has taken hold in markets and among companies and company management. This year we saw Legal & General, big insurance company and asset manager in the UK, come out and say that it's going to go to half-yearly rather than quarterly reporting. one of our predictions in the book, which I hope you all take home and read, annotate, frame, is actually that we will see more of this. And in countries where you can actually do this, whether in the UK you don't have to do quarterly reporting, I understand. Germany, you still do. What is your view about short-termism? How do you actually foster sort of longer-term thinking so that companies can actually build for the longer term? I mean, I'll start with you, Xavier.
I'll make two points to that. First one is more conceptual. Is where's the line between short term and long term? Because the long term is an accumulation of short terms. So the bottom line is a silly answer, and I'll agree to it, but the bottom line is you really need to look at what you're talking about, what particular underlying product, so on and so forth. But to give you a more serious answer, I say, you want to promote long-term, patient investment that will help innovation, that will help things like new technology. The one thing you can do in Europe is recalibrate the fiscal system, which heavily subsidizes debt. So all of us, as taxpayers in Europe, subsidize the buildup of debt in the financial industry and literally kills long-term capital, which is called equity. It was kind of invented in this country, through 4 layers of taxation, 4 different instances of taxation for the same pound or euro, whatever it may be, currency that is earned. You want to promote long-term capital, recalibrate the fiscal system. And then you'll see that equity, particularly patient equity, equity that's needed for venture capital. The venture capital industry in the United States is 25 times larger than the venture capital industry in Europe. And there's tons of unused capital sitting there on the balance sheets of companies throughout Europe. There's no shortage of capital. But that would be my one answer.
How about you, Sergio?
Well, I don't think you're going to address the issue by moving from 3 months to 6 months for this kind of topics. And I think while it's quite practical, it would be a welcome practical move. I don't see it happening anytime soon, at least for banks or for global systemic relevant financial institutions. I think that's the truth of the matter. In general, in this discussion, I would say that the first one that needs to be long-term oriented when they invest money are money managers, and basically not just sell on bad news. And basically, if they are convinced about a story, they should stick and try to push for this kind of thinking at board levels, at management levels, instead of moving up and down shares.
Isn't that a function of the compensation you put on the UBS asset managers?
I don't really think so. I don't really think so. Actually, I have to say that I can only comment for our. We are extremely proud about the forward-looking and long-term incentive plan we have on our compensation. I got to tell you, there is a lot of people, not only in the financial services industry, that could learn about it. But nobody cares about discussing those topics. But I think that there is a responsibility when you invest money. I think that I can see both sides of the equation. But the first things to do when you invest in a company, before you get out because they had a disappointing quarter, you should also make the portfolio manager accountable for that and making sure that he really thought through that. Because too many people who are managing money are just tracking an index. And they are just followers. And actually, this is something that also needs to be addressed.
What about from a policy perspective? Okay.
Well, Brussels has already done a lot of thinking on this, and many of you will have heard about the project of the Capital Markets Union that Lord Hill has been talking about. And this is about trying to take the whole culture of savings in Europe, and Europe has a savings culture, a very good one, but actually they don't have a culture of investing at all. And so to change that culture from savings to investment is an important part of the step here. But part of that is actually getting active capital markets across all 28 countries in Europe. And we may think that we have an active one here in the UK and in France and Germany and in Scandinavian countries, but many of the countries don't. And so we actually have to really try and find ways of getting proper capital market investment mentality across the whole union. And I think it's starting to get some traction and it's starting to make a difference. But we need policy things on a national level, like the taxation policy, where we do encourage equity investment over debt and actually at least level the playing field. Even if you don't give them tax breaks in favour against debt, at least level it, because otherwise you're never going to actually really reap this. But Brussels has actually kick-started some of that investment plan. They've put in place the Juncker investment plan of some 315 billion, which they're actually putting into infrastructure and strategic investments. But they need the private sector to be part of that. And they can kick-start it, they can take some of the risk out of it, but actually ultimately this is about private investors being confident to actually invest in Europe. And without the structural reforms, this will be a short-term measure that has no traction. So that the reform agenda has to work alongside the kick-started investment culture. And with all of these bricks in place, we stand a chance of getting back to the jobs and growth agenda that's ultimately in everybody's interest and making Europe work as a continent once again. And actually, I think it's long been remiss in tackling some of these fundamental issues. They need to do that with an urgency. And they can't see a slight increase in growth and think it's hunky-dory. They have to actually go and continue to work at this plan. I think George Osborne last week, it was quite a timely intervention. I'm not sure who those comments were aimed at. I'm not sure whether it was aimed at policymakers in Brussels or whether it was aimed at his domestic market or indeed a global audience. But actually sitting in the audience listening to him, it actually resonated with some of the comments we're hearing in Brussels. So I suspect it was a very cleverly crafted speech that actually nobody knows whether it was aimed at them or not, but actually they certainly could relate to some of those issues.
That is the great skill of a politician, no doubt. Can I open this up to questions? Does anybody have a question for the panel? I think we have one here. Do we have a mic we can drop?
Philip Souter from Clifford Chance. Just on Brexit, I'd like to ask Sergio and Xavier. Xavier, you in particular said that the markets froze before the Scottish referendum for about 2.5 months. Bearing in mind the fact that in less than 6 months, Britain might have already voted to leave the European Union, and thinking about the way that currency volatility might happen, the way that markets may be stable or unstable, in the run-up to that, how long do you think before the vote we might see sort of instability, market instability, currency volatility start to kick in, and how bad do you think it might be? Or do you think it might not be that bad at all?
Paradoxically, I'll lean towards not being, and actually being quite different from the Scottish referendum, because Scottish referendum was quite a surprise. I mean, that theme had been about. But then when the market realized that the imminence of a possible separation between Scotland and the UK and the implication that would have vast and complex, there was a real moment of pause. This was a true strategic surprise from a market standpoint, which is why the IPO market, for example, froze for a couple of months and volumes really shrunk. I think the theme of Brexit in Europe has been around for a long time. It has strengthened. But I think people generally and markets generally understand that. I think, and I don't want to speak for markets in general, but I think the assumption in general is the United Kingdom will stay. But whether that's true or not, the other side of the equation, if Brexit were to materialize, the consequences are quite complex and will take some time to fully internalize and fully measure and model. So I think the markets are perhaps going to slow down a little bit, but I definitely don't think they're going to freeze. And if you look at the general flows, first of all, we don't know what the question that will be asked the British electorate is, and that will obviously impact the potential outcome of the vote. So there's too much uncertainty about the event itself for the moment for the market to take a definitive position. And I think in the context of markets in general, the points that Kay made were really important. The Capital Markets Union is a huge opportunity for Europe. There's a real opportunity to boost the levels of investment, to re-equitize our societies. We have a single market in agricultural subsidies. That's the first thing we started with. But we do not have a single market in financial services. So there are some real prizes today that can be achieved. And I think the markets will continue to hope for the best. That is my certainly my current assessment.
I partially disagree with that. I think that in the Scottish situation, we saw the volatility and the uncertainty mainly driven on the pound. I think that you would see this uncertainty and volatility spreading over to the euro, because at the end of the day, if there is an exit, it's going to put in serious question marks, also part of the existence of Europe, because other country and other pressures will materialize. So I think that it's going to be quite difficult if the polls are still,
very
quite tight to keep the nerves, under control by investors.
I was going to say, I just wish I had Xavier's confidence in this. My real issue here is that this could be a very low turnout election, because people actually assume that everybody will want to stay and that the status quo is a given. And the people who will be motivated to turn out in that election will be the people who want to leave. And ultimately, in Wales, we've had referenda a lot, and the general turnout is 30% of the population. The ones who want actual nationalistic agendas in Wales are the ones who are motivated to turn out. This could be a turnout election, and in that case, we're in very dangerous territory. And so I would suggest that maybe some of the market forecasters maybe want to look at some of the pollsters' work and look at what a low turnout election actually does, because I'm not sure it's going to actually really get everybody motivated to come out and vote in the way that Scotland did.
Interesting. I can tell you the experience in Switzerland, because we go to vote every 3 weeks on things. And the real dangers, which is a privilege we have, by the way, and I think that maybe Europe could learn a little bit of that. But I think if it's a 50-50, usually in Switzerland, you have higher turnout. I mean, if the polls are undecided, people feel more obliged to go and vote. The problem is the other way around, when people feel, they don't need it because it's gonna just happen the way I want it, and then it is not, because there's only one side showing up to the polls. So
that's an interesting risk you bring up. Time for another question. Right here.
Adrian Russell from Euler Hermes. Given everything we're seeing in the markets with short-termism and protectionism, what do the panel think are the prospects for global trade? And if global trade kind of starts seizing up, then how do we kind of grow the world economy out of the kind of the muddle that we're in at the moment?
Good question. Anybody want to pick that up? Oonagh.
Well, I think that developments in global trade, which is already quite strong, but I think there are going to be quite serious geopolitical disruptions during this year. So I think that will halt such developments.
I do happen to watch trade statistics, including rail freight, particularly in the United States, and those numbers are coming down quite fast.
But that's commodity-based, most of it, is it not?
It's part of trade.
Coal,
it's consumer
like
goods in the United States, a lot of consumer goods. Yeah. So it's not just the commodities, it's computers and auto parts. And in the United States, they're coming down quite fast now, which just makes me think, and that's probably one of the best indicators of short-term strength in the economy. And global trade, particularly shipping, is also coming down. And I can't see in that environment, again, I'm probably on the other side of the consensus, that the monetary environment is going to tighten up anytime soon, which itself provides some support as long as the economy itself doesn't completely come off the rails.
Well, you see, one of our predictions is actually that the Fed might have to lower rates by a year from now. Because
I think you may be right.
We'll see.
But in terms of global trade, there are lots of other instruments out there that are currently being explored, and certainly I think we've got a historic opportunity between the EU and the US, the two biggest consumer regions. I mean, you're talking about 800 million people. And if you bring those two together in a tariff-free way through a trade and investment partnership, which is currently on the table, If they conclude that before the US presidential elections, there's a huge opportunity. There's a major risk that this doesn't get concluded beforehand. And then we actually stall what could be the biggest boost to trade that is currently out there. We've got the Canadian agreement on the table. It's currently being in its final stages. The South Korean one that was concluded last year has had a significant impact on the UK's GDP. Suddenly our export to South Korea was a phenomenal increase and boost to our GDP. So these trade deals do work if you remove the tariff barriers by having those regional trade agreements. They do actually have an effect. So that TTIP could potentially unlock some major opportunities between the two biggest consumer regions.
I would just counsel a whole lot is not going to get done in the next 9 to 10 months.
It doesn't need Congress
in the US,
nor the Senate. So actually it could actually be done if the EU negotiators agree with their US counterparts. But there's quite a few things like chlorinated chickens standing in the way.
Right. Well, on that happy note, but optimistic note, I think we should end it here. There's a bar out there that's calling all of your names. I appreciate you all coming out here. I want to thank the panelists. Please thank the panelists. And the people who put it together for us, thank you very much. Thanks.